All right, everybody, welcome back to Trading Corner. Things are getting spicy. We've got Iran headlines flying around, which
Yeah.
usually means oil traders are locked in. Market's still close to record short. Are you seeing your counterparties come in and panic short covering? Or
Um, Actually, yeah, just on that quickly. Surprising, right? The data came out this morning, and to be honest, I thought more of the market would have covered their short.
me too.
For a $9 move, I don't know, I found it particularly surprising.
Yeah, I mean, the data, the CFTC data, the COT data rather, because some
Yeah.
of it comes from the COT, some of it comes from ICE. It still shows record shorts,
Yeah.
but that's through to last Tuesday. But still, like, we have a CTA
Oh,
model
okay, I
that
see.
should give us some indication of where that data is going to be
Mm.
for, through to today, Monday. And our CTA model makes it seem as though there still hasn't been a lot of short covering. And I
Yeah.
think, basically the way that the CTA model works, the CTA has a couple different speeds, which are basically different moving averages. It'll have a short speed, a medium-term speed, and a long-term speed. I think the downtrend was so well established that it's going to take more upward price action for CTAs to start covering.
Yeah. Deep pockets, right?
Yeah,
So,
deep pockets.
yeah, I mean, exactly. Our internal one was saying that the market's still quite short, which I was personally this morning quite surprised by. I mean,
Yeah,
you move $9 on flat price, you'd expect some stops to start getting triggered.
yeah,
I'm assuming on the way down, the average entry was around 76,
yeah.
75, 76. So I'm assuming if like the majority of the market's kind of out of the money at the minute. I mean, let's see. This week might be more telling if nothing happens geopolitically, whether the market re-enters into some shorts. But obviously they didn't get out, so maybe not.
Yeah, I mean, I think that the market's on edge right now. I think that shorts are either going to get squeezed like crazy and entire year's worth of P&L is going to be lost,
Yeah.
or we're just going to, I don't think there's fresh powder to be deployed into new short positions. I think the
Yeah.
market's already max short. So I think part of what you're seeing in terms of participants looking to kind of cover their backsides is they're buying calls.
Yeah.
Call skew has just exploded. Volatility, implied volatility is exploding. Realized volatility is exploding. So I think that you're seeing a lot of people who are short buying wingy calls just to hopefully hedge their positions.
Yeah.
So maybe that's part of why we're not seeing the sort of positioning data getting a little bit more clean. But I think this is setting up for an epic short squeeze if something does actually conflagrate in the Middle East. And I guess I want to get your opinion on this because
Yeah.
I read oil market consensus, which basically says Israel won't hit Iranian oil facilities, or at least export facilities. Maybe they'll hit a refinery or something because they don't want to trigger a wider war. Do you think it's possible that, obviously neither of us know, but do you
Yeah.
think it's possible, or should participants who are short be concerned that Israel is just going to take out a bunch of production in the Middle East?
Um, So I guess two things. Do I think it will happen, and how will the market respond if it happens?
Yeah,
I think personally, no. The reason I don't think it's likely to happen is because it's been so well televised that kind of you can go hit anything else apart from oil.
yeah.
That if you're going to hit something, go for it, but do not touch
Don't touch the production.
the production. Yeah. So I mean, potentially they'll look at refineries, but again, I just don't think the trade-offs that good. You could potentially look at some other industries that Iran focuses on, or hit, I don't know, some of the export terminals or something like that. I think the reality is it will be maybe they'll hit some ships or hit a port, and not really touch production. Either way, I mean, it might still look like that crude's going to be landlocked a little bit,
Yeah.
but the disruption will be way less severe. So maybe it will be out for a couple of weeks, rather than, I don't know, potentially 2 months it could take for really fields to come back, after a big hit like that. But yeah, of course it will impact flat price, it will impact all the differentials, it will impact freight routes, all of which we're starting to see already, the anticipation for it, but the positioning's not there.
Yeah.
So I think the market isn't really bought into the fact that something serious is going to happen still, which
I completely agree with you. The market's behaving in a either very intelligent way or a very complacent way. We'll see which. I think it's relatively a bit of both. I think that I would expect to see more short covering.
Yeah.
I'm surprised there isn't more short covering in futures space. But realistically, like, a lot of the moves this year, if not all of them, have been an excellent fade.
yeah.
And While I do think it is possible that Israel would attack something in Iran that would cause flat price to really ratchet higher, especially on the consequent short covering, I don't think this is going to escalate into a broader Middle East conflict that looks like, you know, kinetic warfare
No.
across multiple Gulf producing countries. There is speculation that, Iran has said, hey, if you hit our oil infrastructure, we're going to attack other Gulf producing countries' oil infrastructure, like Saudi, UAE. I don't think that's in their best interest to do that.
No.
I don't think they would. I think Iran's goal is to kind of surround Israel with problems and isolate Israel from the world, which they've done a decent job of. I don't think they would squander that by making enemies of Saudi Arabia and the UAE at this stage, or escalating conflicts with those countries by taking out their infrastructure, like they did back in 2019 when there was actually a war between the Houthis and Saudi Arabia. Then it made sense. This time, I don't think that it's a good strategy to isolate Israel by attacking Saudi Arabia. So I totally discard those threats. And I don't think there will be enough production disruption, even if Israel targets Iranian export facilities. I don't think that type of warfare, even if it did happen, which I don't think will happen, but even if it did, I don't think that takes out enough production to offset the spare capacity that OPEC has floating around.
Yeah.
I think basically the oil market, if we're going to break out of this range to the upside, like if we're going to go above $90 a barrel, I think you need to see Iran shutting the Straits of Hormuz for a prolonged period. And I don't think they'll do that because that's suicide for their regime.
Actually, it's I was talking to our Dubai trader about this last week, and actually the way that the benchmark has moved. So typically you trade Dubai as a differential, Brent versus Dubai. So the West versus the Eastern contract, and I was really surprised that contract has rallied. Brent has rallied relative to Dubai because obviously all this conflict is in the Middle East. And he was just saying that potentially, actually, instead of shutting the Suez Canal, that there are going to be freight difficulties in the Red Sea. So actually, it's more that the crude that flows from east to west is going to be in more trouble rather than the crude that flows west to east. And so for that reason, the benchmark, Brent Dubai has rallied, i.e. Dubai has come off relative to Brent, which I thought was particularly interesting because
it's counterintuitive.
Exactly. But for the pricing contract in Dubai, that really has strengthened. And I guess people are happy to pick up cargoes here because we have to remember all this financial positioning, all of the open interest, etc. that they're talking about, it's all financials. So what is actually going on to the physical barrels here? That's what's kind of more interesting for me at the minute anyway. So Dubai is holding. People are happy to be buying crudes around, on a 2-month spread around 150, which are good premiums. I'd say it's a very healthy market right now, which is to be expected given this war premium potentially. And if we look at dated now, so dated Brent in the kind of more Europe, of course, it's looking like there's a bit more strength coming in again. So, as you were just saying with the option premiums, we're seeing, the premium for calls really rallying. We've kind of had the same with futures versus the swaps market. So a lot of money is piling in, potentially, short covering in some Brent spreads. But the GFL curves, so the actual swaps, are really, really depressed right now. So it's one that I'm keeping an eye out for sure. I think the physical versus the financial markets are going to rally. So how I would express that is a long GFL against short Brent spreads.
Interesting.
I think we've got some considerable upside, especially as we're coming out of turnarounds. So we're kind of done trading prompt and off cycle. We should get refinery buying flows come back in, which should be from now, to be honest. I wouldn't be surprised if some things have already been booked into, Central European refiners. And I think that's going to be reflected in these physical diff premiums picking back up. So I mentioned last week, we kind of came off around 50 cents on the physical diffs to around 60. I expect that to be totally retraced.
Interesting. Yeah, hearing you articulate it that way is helpful because what I'm struggling with at the moment is the fact that the market is such a mixed bag, right? Like even if you take out this whole geopolitical situation and ignore war risk, imagine it's totally calm in the Middle East. You have so many bearish factors like this looming overhang, the looming sort of OPEC production hikes, the prospects of cheating, pissing off Saudi Arabia, which is threatening, sort of soft threatening a market share war, jawboning $50 Brent. But then on the other side, you kind of have seasonally low inventories, physical demand picking back up. We're through turnaround season, GDP growth outperforming, oil demand outperforming, every analyst revising their sort of balances tighter and tighter for 2025. It's just this very mixed bag that's kind of hard to digest. You have record shorts because of the well-telegraphed bearish narratives, but that in and of itself is a bullish feature. So a lot of coiled springs on both sides. I've been a bit confused about how to play it, just from a flat price perspective. So I've just tried to reduce it down to, hey, you've got record shorts in a geopolitical situation in the Middle East. So with flat price on the low end of the range, be long. And when we, breach $80 and get up towards 82, 83, the risk reward is kind of gone. So
Yeah.
it's like a tactical trade. But to hear you articulate it in terms of like spreads versus DFLs, I think you have a kind of a better trade idea there. Like the
Yeah,
dips
well,
and the physical spreads are a little bit more interesting right now.
I think there's always, yeah, exactly. There's always that relationship between, you know, what the market sentiment is and where the physical barrels are ultimately trading. So
Yeah.
one can overwhelm the other at different points in time. But what's interesting right now, I think, is that we're coming out of turnarounds, margins are okay, and some of the differentials, or the physical differentials that are implied on the curve, look really low, to be honest. Like,
Yeah.
we're looking at kind of December barrels which are pricing around 20 to 30 cents. Like, if I was a trade house, and by the way, I do actually think trade houses are a lot more bullish than managed money is.
Yeah.
But if I was a trade house and I was looking at that, the potential to take cargoes at 20 to 30 cent premiums when we're in a war, when people are probably going to be drawing down their inventories at year end, refiners kind of, typically book as much as they can in the first half of December, just so that
Does
they're
that
not
happen outside of the
covered
United
short.
States, by the way, the year-end inventory drawdowns? I
Yeah,
thought that was just a U.S. tax phenomenon.
I think it's quite big in. No, I think it's quite big in Europe as
Okay.
well. I mean, to be honest, I don't have too much experience there. We don't trade physical cargoes, but typically you do get that buying appetite from refiners just before we go into Christmas period, and so for that reason, the weeks kind of after Thanksgiving and before Christmas, typically there tends to be a lot of physical activity going on. And if that's what we're looking at on the curve right now, and you can kind of hedge it at around 20 to 30 cents premium, it's a pretty good trade, I would say.
Good optionality there.
Great optionality. And we have this war premium as well. So I'm looking at that part of the curve, and to me, it looks undervalued, to be honest. And the only reason it is currently undervalued is because it's just a little bit too deferred right now. So we might potentially get this roll up as this position becomes a bit more prompt. People realise that actually the diffs that they can get are pretty favourable. So along with that, we have short positioning in DFLs, which I don't really understand, to be honest. I don't see why the market would be short DFLs here.
Must be against something.
Against Brent spreads, typically. So more often than not, maybe they, if they're looking at the two contracts and they're thinking that this war premium is going to add more to the futures contracts than the swaps, then typically they'll buy one against selling the other, just as a bit of protection. And they might have some long physical cargoes against that as well. So it doesn't necessarily mean they're naked short DFLs. But I do think those two contracts are going to catch up. So it's definitely one that I'm going to keep an eye on for the next probably week. In the next week, I assume it will realign. I think it's about 10 to 20 cents undervalued.
So what happens if there's an all-out war in the Middle East? Let's say that the things that I don't expect to happen anyway. Let's say that Israel just takes out Karg Island and turns it into a flaming pile of rubble. And then let's say that Iran retaliates by just taking out Abqaiq in Saudi Arabia and Fujairah in the UAE, and it's all the infrastructure goes up in flames and cruise missiles are flying across the Strait of Hormuz, just like apocalypse scenario. What happens to that trade?
It should rally, because what you're really targeting are the physical cargoes, which will be represented better in DFL. So DFL is a more prompt
I would have thought the
application.
futures go up, but the physical, this isn't my expertise, but the physical stays a bit depressed and DFLs. No, I mean, they should rally in most
They
geopolitical.
should both rally, to be honest. The relationship between the two typically holds very well.
Okay. So basically, the trade you're describing, long DFLs, has amazing optionality here. And there was good optionality in Brent options up until last week, but now that optionality is expensive AF. So
That's the thing. Once the trade is gone, it's gone. So
now's the chance to pile in, basically.
I think so, yes. For me right now, it's the only thing on the board that looks like it has really
Good
decent
reward.
upside, yeah. Whereas futures, I mean, we've had this big rally. All the flies in the front are still fairly depressed. We were kind of talking about that a bit last week. After a week expiry, what do we expect to happen to futures? So those flies have stayed a little bit low. I expect those to start picking up as well. So I think a lot of the market positioning and spread right now on the short side is in the back of the curve. Which potentially they've been kind of slowly getting out of, which has kind of put a cap on the front flies. That could get reversed.
Right. Okay.
Once everything kind of calms down.
So basically, your DFL trade doesn't really have much downside, but it has significant upside in the crazy scenario. And yeah, in flat price, there's not really much good risk reward. I think we're headed straight back to the lows if this plays out like April's conflagration or lack thereof.
I agree, but that's the thing. Even if flat price does go back to $70, $72, let's say, nothing really needs to happen to the structure of the Brent curve or the GFL curve, etc. I think we can easily wipe out $5 without structure really moving.
Yeah, so maybe the trade would be buy DFLs and sell some expensive strangles in options space.
Yeah, not a bad shout.
Buy the cheap options, sell the expensive ones. That's an interesting idea, actually. Ultimately, I guess it's hard to talk fundamentals in the face of all this extreme, hard to predict geopolitical risk. But
yeah, I mean, I guess it comes down to position sizing. The market's over short. Probably it's not the best time to put all your bullets on one or two trades. Maybe it's looking more like a balanced book at the minute, but looking at products even, I don't think there's going to be too much exciting to happen there.
I still like diesel cracks.
Okay.
I still think
they're starting to pick up a bit, right?
Yeah, they have been, even against the backdrop of all this geopolitical flare-ups. So
well, it does make sense as we have been in turnarounds. Let's see once the refineries start picking up their run rates again.
Yeah, good point.
What happens there? And it's still quite mild, right? We're not getting any kind of aggressive weather yet, so that could help support those cracks into the winter.
Yeah, it's been 2 mild winters in Europe. I think we're, I don't know if these are independently distributed events or not. I'm not a weather expert, but, finger in the air. It feels like we're due for a frigid one.
Q1 is, I remember last year, it was absolutely freezing. And then we had the Texas freezers, that really impact refineries. I think NGL's absolutely roofed off the back of that. And all other products were really held up. So I do think we will, I agree, I do think we will get a cold winter again, but potentially a little bit later. So maybe it'll hit in January again, which should help support the crack structure in Cal 25 again, right?
Agreed. Well, let's see.
Let's see. Yeah, that's it. Anything else you want to touch base on?
No, I mean, just all eyes on the Middle East.
Yeah, reactionary. I mean,
time to clean up the book, reduce line items, and
let's bring our
put on the best
duvet and pillow into the office.
Pretty much.
All right, cool. We'll catch up next week then.
Good talking. Till next week.
Thank you.